Good afternoon, everyone, and welcome to the SIA Wealth True Tactical Monthly Webinar for July of 2021. My name is Colin Szynski. I'm Chief Market Strategist with SIA Wealth Management. Jeremy unfortunately couldn't make it today, so I'll be filling in and going through a number of questions from you, our advisors, and our clients. If you have any additional questions, please type them into the chat or the questions section over on the right-hand side of the screen, and one of our team members from SIA Wealth will be happy to get back to you. In addition, I just wanted to note that we will not be holding a monthly webinar in August, but they will be resuming in September. So on that note, I will move forward on to the first question. Our agenda today is we're going to offer some market insights into what's been happening in markets around the world, and go through some of the questions that we've received prior to today's presentation. So the first question we've had is, and this has come from a lot of advisors, is what's happening with momentum in equity markets. And we've talked previously about how we've seen market momentum slowing since May. And can I talk a little bit about what's been happening? So basically what's been happening is, as we look here on this first chart, that when we came up off the bottom and through the fall and the winter of last year into about February, we had a concerted upward movement in pretty much all equity markets around the world. Since then, we've seen markets start to level off and really go sideways. In this particular chart, the one market that continued to climb was the Canadian market. That's because we had a rally in commodity prices, particularly energy, through the spring. Even then, we've seen the TSX start to level off. It's not unusual either. There is more of a concentration in the TSX of sectors that move a little later, of resource and commodity-based sectors. So to see the TSX kind of start to move up later and finish its move a little later is not uncommon. And now it's starting to go sideways, as we've seen with other equity markets around the world. And there's a few reasons for this, why this is happening. The first of which is, quite simply, we're a year now from the bottom of the bear market, and it's not unusual for this to happen. First of all, we're seeing signs that perhaps the liquidity that came in from the central banks might be starting to slow. Second one is that flatly some of the hurdle rates are starting to get higher. We had a huge divergence a year ago, and some of the quarterly earnings that are starting are a bit distorted. But on the other hand, there were also companies that did really, really well in Q2 and Q3 a year ago, and their momentum may be starting to slow. So as we start to lap higher comparables, the equity market, the growth in equity markets and in earnings in particular does start to level off. It's also not unusual at this point in the cycle for things to just pause for a while. And there's two types of corrections that we look at. Sometimes there's the more visible one where the market plunges 10% in 3 weeks and everybody goes, oh, okay, that was a correction, and then it resumes its upward course. The other one is the markets just kind of grind sideways for 6 to 9 months, and it's more of a consolidation or a pause. And when we get these, they're normal, but they are confusing for investors because on the one hand, equities are struggling to go higher. On the other hand, they only go down so far because the fundamentals are starting to catch up to the valuations. And while the fundamentals are catching up to the valuations, we end up in this situation. Even today, we saw earlier this morning a very strong first day of results out in the States. Goldman Sachs, JP Morgan, banner results, absolutely incredible, and their stocks go nowhere. On the other hand, we had PepsiCo put out good results and they picked up. And the reason is, flatly, if we look back, Goldman Sachs and JP Morgan were up huge over the last year, whereas Pepsi was kind of flat. So some of the banks that looked like had already priced in positive results, whereas maybe Pepsi was more of a legitimate surprise for investors, and we're seeing them pay for that one. So that's what we're kind of running into now. Equities have moved up, and now the fundamentals are catching up. And while we're in this sideways grind in the markets. The second thing we're seeing, and I'm showing it on this chart, is a lot of sector rotation. We're into a period of what I call rolling takedowns and rebounds, where you'll have a correction in some sectors and other sectors will do well, and then it flips. And so we're seeing this here. If we look at some of these, this is the blue line is energy, the orange line is transports, and the gray line is the NASDAQ. So the NASDAQ back in February, March, April, going flat to even down a little bit. And meanwhile, at the same time, we had the transports and energy, which were lagging sectors and rebound plays were taking off. And now we're seeing that in the last month or so, the NASDAQ has started to get more traction. The energy sector has gone sideways, and transports have actually been coming back down. So that's important as well, just to see that kind of very quick, constant rotation within the markets. And we don't have an upward trend. We don't have a real downward trend, but we're into this more of a situation where we're in a sideways trend. And so that becomes a little bit more difficult and challenging. The other thing we're seeing with this is that some capital has started to quietly work its way back into the bond market, whether that's people looking for a haven for capital or just that interest rates have started to come off a little bit again. We have seen a rebound in bond prices. This chart here shows a massive run up last year in February and March of 2020. That was, of course, the huge flight to safety when the stock market collapsed. Then we saw through the summer into the end of 2020, the bonds just quietly drifting back down. Then early 21, when the 10-year yield started to spike, bond prices collapsed. And now since about beginning early May, the bond prices have actually been coming back, including a new up leg this month, while the interest rates have been coming off. So what does that mean overall? There is a bit more volatile and more challenging market for equities out there. It's not a full-on, we're not seeing a stampede out, but we are just seeing that equity markets are struggling. They're struggling to maintain momentum in either directions. There is a little bit more volatility. There is a little bit more risk in the markets. Because of that, in a number of SIA Wealth Managed portfolios, we have started to build up cash a little bit in terms of positions. The amount of cash varies from portfolio to portfolio, but as we've had stocks go on and ETFs go on sell signals, we haven't automatically been replacing them all, and we have been building up a little bit of cash as a defensive position during this time of higher volatility, and potentially then setting ourselves up to be able to take advantage of opportunities when they present themselves once again. Now, the next question we had was related to OPEC and oil prices. What are some of the possible implications for the price of crude oil resulting from the recent breakdown of OPEC discussions between Saudi Arabia and the United Arab Emirates? So I'm going to go to this slide here, which we got from the Energy Administration in the United States. And this is their history and forecast for oil demand and oil supply. So production is the blue line, consumption or demand is the brown line. And so what we saw obviously in 2020 in the first and second quarter, the demand for energy absolutely collapsed. And because of that, OPEC plus and the prices collapsed, and then OPEC plus in particular really slashed production in order to take that excess supply out of the market. As we moved into 2021, demand has bounced back and supply has slowly been coming back on stream. And what happened was a couple of weeks ago, OPEC plus were meeting to discuss, well, how are we going to continue bringing production back online for the rest of the year? And they had a deal for 2021, but then in 2022 they were like, well, we'll just kind of sit for now. But some UAE was one, and there may be others for as far as we know that I guess they want to bring production back faster. And because this obviously has impacted their national revenues, and so there's a big fight on right now between the UAE and Saudi Arabia essentially over how quickly to bring back production to meet the recovery in demand. And so this is still playing itself out and could cause volatility in oil prices over the next few months until this sorts itself out. It remains to be seen if countries are going to walk away from the supply cuts and start producing more again, or if they're going to maintain their discipline. That all remains to be seen how this is going to shake out. But it is an issue that could add volatility to oil trading over the course of the summer. As it is, the oil prices had quite a strong run over the last few months. Starting in December, it had broken out of a downtrend at about in the low 40s, and then we've seen a rally up into the mid 70s. Being here in the mid 70s is quite important, because it's getting back to the 2018-2019 peak for oil prices. Back at that point, President Trump had decided he'd had enough. He opened the strategic stockpiles in the United States, the Strategic Petroleum Reserve, added supply to the market to knock the price down because he was concerned about rising inflation and that it might force higher interest rates and other things that he didn't really want at that point. Then, of course, on the other side of that, so I call that the pain threshold of the president of the U.S. On the other hand, there's also a pain threshold for Saudi Arabia and OPEC and other countries where if price goes down too far, then they just lose tons of money. And that historically has been kind of in the 40 to 50 range. And so right now, if we say there's a wide range between, say, 40 and 80, we're up at the high end of this. So now the question is, would they maintain supply discipline and could the price go higher? We don't know what President Biden's pain threshold is, but when he was VP under Obama, oil prices spent a good chunk of their administration north of $100. So it remains to be seen what Biden would do if the oil price started going above $750 or 80. But it does look like some of the OPEC Plus members, the Emirates in particular, are starting to see these prices and going, gee, we want to bring back supply on faster. So it can come from different directions and different places. So it's something we're definitely keeping an eye on as we're up near this key level. Next question. Over the last year, the big story had been that world governments and central banks were providing support for markets and economies through fiscal and monetary stimulus. In recent months, however, this tone has started to change back towards regulation and intervention. So the question is, how might this more adversarial tone impact stock markets and sectors going forward? So we'll show a couple of examples here. The top left one here was from last Friday. President Biden came out with 72 initiatives in terms of new regulations for the tech, the healthcare sector, industrials, and other areas. We have one from the Wall Street Journal again talking about Biden particularly keyed in on high drug prices in the United States and wanting to bring U.S. drug prices down closer to what they are in Canada. Last week, another big story was Didi. It's a Chinese ride-sharing company, and 2 days after their IPO, China went after them on a cybersecurity investigation. And so basically, they felt that this was a crackdown by China on their company's listing in the U.S. China a few months ago went after the cryptocurrencies, both in terms of trading, in terms of mining. And also we had in June, the 130 companies backing an OECD plan to set a global minimum corporate tax rate. So free and unfettered regulation for corporations. That pendulum looks like it's gone too far one way, and now it's starting to come back into a little bit more regulation, a little bit more intervention. The way that markets look at intervention by governments is, and many things, whether it's political or economic, it's through the lens of what does this mean for corporate profits? What does this mean for growth? What does this mean for dividends? And so in this case, a more concerted and coordinated intervention among governments in the markets is another headwind for stocks. It doesn't necessarily crush them, but it does put a headwind in front of the upside when we don't know what these interventions are going to mean, what more activist government means in terms of regulating and possibly slowing growth for different sectors. And the impact may vary from sector to sector. Here's an example here of from the impact of China on Bitcoin. Earlier in the year, Bitcoin had a huge run. It was already starting to level off. And then in May, China came out and started cracking down on cryptocurrency trading and saying banks can't hold it and individuals can't hold these things. And then smash, the price was just hammered and it's continued to drift down. They've also been cracking down on cryptocurrency mining, basically under the banner of climate change and global warming, because cryptocurrency mining takes up an incredible amount of electric power to do so. There's things out there that have now put headwinds in front of things like Bitcoin and other cryptocurrencies. This was another example here. This was Didi Global from last week. It had its IPO, had come out at $14, traded above it a couple of days, and then when China announced the cybersecurity crackdown, it gapped it down back under the IPO price and continued to drift lower from there. So it's another example of how, generally speaking, markets don't really like government interventions and increased regulations. As I say, it may not necessarily crush something, although it does in some cases, but it does certainly, at a minimum, put a headwind in front of equities. Another question we had was pandemic 2.0. As many of the world economies have been reopening lately, there has been more talk of variants that could in future potentially force more lockdowns. And so the question was, what's the risk to the markets of this potential second lockdown scenario? So basically what I would say to this is, so far markets have been recovering from the March 2020 lows. That was the point of maximum uncertainty. And as we got past the election and as we got into the rollout of vaccines, so far so good. Markets have been generally steadily climbing. There is a risk, though, in the short term that could spark corrections, perhaps not to the extent of what we saw in the spring of 2020, but certainly it's possible that these could either limit upside or cause corrections in some sectors. In the case of the energy sector, it's been recovering very strongly, but we have seen it start to level off in more recent weeks. The bigger one area where we have seen it in particular is in transportation stocks. The Dow Jones Transportation Average, on anticipation of more reopenings, had been screaming up from last summer and had a huge rally February, March, April, May. It leveled off in June, and into July, transport stocks have actually rolled over and have started to come back down. The feeling here was that if there's new variants, could lead to restrictions or lower demand for travel, and that could take some of the wind out of their reopening sales. So that's something we've seen there in terms of that. Our next question was market insights for inflation and interest rates. Earlier this year, we saw rising commodity prices and their potential for increasing inflation becoming a concern. Is this still the case? And the answer is, it's starting to look, though, that central banks may at least be starting to, if not outright slow down their stimulus, at least they're not adding any more. So if we look at the top left chart, that's the Fed adjusted St. Louis Fed adjusted monetary base, or also known as FRED, also known as the Fed's balance sheet. And essentially what we can see here was there was a big run up in money supply in early 2020, came off a bit over the summer, then had been quietly increasing, and now looks like it's starting to level off. That the Fed is less inclined perhaps to keep pumping new money into a recovery economy, because if they overstimulate, they run the risk of spiking inflation, which would then force them to have to raise interest rates. That was a whole problem we ran into earlier this year. Commodities spiked, inflation started to pick up, people got worried the Fed might have to raise rates. The Fed has now spent about 3 months trying to tamp that back down to varying degrees of general success. Here on the bottom right, we have the monetary aggregates of the Bank of Canada. And what is clear here with this is that in Canada, the central bank actually has been starting to slowly take some of this excess money out of the system. And we're actually seeing the aggregates in Canada have not just leveled off, but they've actually started to come down. So the Bank of Canada has been the most hawkish and is the farthest down this road so far. It's one of the reasons why we've seen the Canadian dollar go up so much in the last few months, getting above the 80-cent level against the US dollar. And that's why we've had the Fed has stayed dovish, the Bank of Canada has been hawkish. Now, something we're watching for is at the end of August, the Fed holds its annual conference at Jackson Hole, Wyoming. And this is an event where central bankers from all over the world come, and Fed speakers from all over the world come, and Powell will likely be talking, a whole pile of other people. But historically, that's an event that Fed chairs have used to signal changes were coming to monetary policy. Yellen did it, Bernanke did it, and perhaps others even farther back in the past. But that's a really big deal. It's at towards the end of August, and that could then set the tone for Fed meetings and possibly even for the markets for the heading towards the end of the year. Inflation has been on the rise. The U.S. consumer price reports came out this morning, and both headline inflation and core inflation were higher than expected. So even though commodity prices have been coming back off, inflation pressures are still quietly building into the system, and so that's something we'll be watching for particularly as we get towards the end of the summer. This chart here shows the CBOE. The gray line is the 10-year interest rate in the States, and then the other lines are various commodity prices. So orange is lumber, black is soybeans, copper is the blue line, and the purple line is crude oil. And so what we saw was that earlier in the year, in late 2020, we saw commodity prices all starting to increase. And then in early 21, then we saw that translate into the 10-year Treasury note yield started to increase, and people started to talk about inflation and will the Fed have to cut back their stimulus program, and when might they raise interest rates? Now, this fear has kind of been easing since March, and it's been easing since March because the Fed's been talking down inflation. And they've been saying, don't worry about it. We think it's transitory. Commodity prices will come back down. And to me, I mean, it sounds like essentially they're looking at some variation on the lumber, where we saw lumber exploded in April and May, and that's been answered by a huge increase in supply, and now the price is back down. And I think the Fed is kind of counting on other areas doing the same thing. The higher prices would lead to more supply, and that another piece of which is just that commodity prices were so depressed a year ago that year-over-year comparisons are quite high right now. But if we go 3-6 months down the road, once prices had bounced back, the hurdle rates for comparison get higher, and so we may see inflation just kind of moderated just on its own, just like we're seeing in equity markets. So at this point, it's not a huge concern, but it is possible. The Fed has been saying late 2022 perhaps for a rate hike, but there's still the possibility that they could flag that they may start to withdraw the QE asset purchase type stimulus sooner than that. This is a little bit more clear on what's been happening with the 10-year interest rate. We can see it was creeping up through late 2020, had a big surge in early 2021, January through March, kind of leveled off through June, and now has started to come back down. And just like I showed earlier in this presentation, the timing of that rollover in the 10-year interest rate kind of also coincides with that spike in bond prices. And so we are starting to see a little bit of a feeling out there that perhaps the road to recovery might be a little bumpier. Perhaps it might not be as strong as we thought. Perhaps there's a little bit still lingering risks out there than had been previously thought. And I did mention that we've been seeing increasing volatility, a little bit of an increase in risk, and just as a reason for a little bit more cautious stance on the markets rather than full pedal to the metal. And we're starting to see this in other places as well, in interest rates, in bonds, in the way commodities are acting, and the way equity markets have been acting. And so this kind of push and pull between perhaps a little bit more risk in places, or a little less stimulus, or rolling corrections, or and on the other hand, just generally improving fundamentals underneath, kind of keep us in this push and pull tug of war that this could go on through a good part of the rest of the summer, and perhaps even into the early fall. As I said, it's not unusual for these kind of situations to play out over 6 to 9 months. The current situation we're in started in February, so that's kind of August to November is when we could see this running through. It would not be unusual. So at this point in time, I will. That concludes my prepared remarks. Again, if we'd love for you to send us your questions. If you have questions, in addition to typing them into the chat feature here, also please send your questions to sales@siawm.com. We'll definitely add the most frequently asked questions each month into our Market Insights segment. And in addition, some of our team, for more urgent questions, can get back to you as well. And this is our final slide with our fund codes and sales information. So that concludes our presentation for this month. As mentioned, unfortunately, Jeremy was unable to make it, but he will be back for the next one. We will not be holding a monthly webinar in August, but we will be resuming in September, and we look forward to speaking with everybody again then. I hope you all have a great day.